Okay, I think I'm ready. We don't have to count down. Let's get this show on the road. Gotta press the right button though. Oh yeah, there we go. Perfect. How you doing, friends? Today we're going to talk about scaling your account. And I know you've heard it probably 1,000 times. Just be consistent and profits will take care of themselves. That sounds great until you realize those small, steady wins can quietly lock you into small, steady returns. Now today, we're going to flip that thinking on its head because in 0DTE and convex trading, consistency is not the same as growth. And growth comes from one thing: asymmetric setups that let you risk little to win big. And quite frankly, over time, you want to use that so that you can start compounding your returns. And the key to compounding is to not draw down. And the key to not drawing down are very small asymmetric trades that can return big. That small defined risk is what's going to keep you your drawdown low, your volatility returns low, and then allow you to compound. But we're going to get real deep into that. So welcome to episode number 9 of the Final Hour Show, where we cut through the noise and focus on what actually scales in trading. Now, I'm Coach Ernie, and today we're going to dive deep into scaling 0DTE profits using asymmetric trades. Now, if you ever felt like your consistent results are stuck in first gear, this episode is for you. And if you, I may or may not have time to get through all the points that I want. And if I don't, then just put a note down below, put a comment, and I'll get back to you. So we're going to define what asymmetry really means in 0DTE strategies and break down the scaling problems that most traders face. Now, this is a what I would call a high quality problem, because first you have to be consistent and make money before you can even consider scaling to bigger size. Most people want to get to big size as fast as they can. They think that is the panacea, Get to the big size and I'll make more money. I wish it were that easy. So I'm going to walk you through exactly how and when to press your edge without blowing up your account. And yes, we've got a case, I do have a case study that shows this in action. In fact, I think I'll show it to you right now. It's my own case study. So, and I use this to demonstrate with my coaching service exactly how I was going to go about scaling. And it's a process. You have to recognize where you are, what your potential is, what your growth rate is, and where exactly you're going to scale. So let me see if I can bring that together. And we're going to go to here. All right. So I'm going to show you one of the principal problems with scaling. And that is thinking that everything's going to be copacetic, right? So this account, by all accounts, you look at it and you say, man, that is awesome. I wish I could have that kind of trading account. It just goes from bottom left, top right. That guy never loses. But in fact, I lose quite a bit. I lose over 50% of the time. You can see my win rate is only 48%. But that's not the main point here. The main point is to look at drawdown. Drawdown's very small. My position sizes are very small. My average win to loss is much bigger than my average win is much bigger than my average loss, almost 2 to 1. And you'll see it's super, super tight, right? I mean, not a lot of up and down swings, big peaks and troughs, none of that. Now, at some point, I have to decide, well, first of all, I set out saying that, hey, this is my position size. I want to keep that position size relatively static. That way I can collect the kind of data and understand my returns and know what I can do, what I can't do. I got to stay within my lane so that I know exactly when I can scale. And scaling isn't something that you just do bam, like I've made a bunch of money in 1 week and therefore I'm going to scale up the next week. All right, so it really comes down to your position size and its size relative to your total account size. And also by controlling your drawdown. These all come together. So if you can keep your position size low for a period of time, you're going to find that your volatility of returns, that's the up and down in your drawdown. You'll see the drawdown is in the red chart. You'll notice that the drawdown never really exceeded about maybe 1.5%, maybe 1.75% average. And then slowly it started to get nice and tight. And you can see that also in my trading. Starts out a little bit up and down and then starts getting nice and tight until we get right here, right in the H column, right there. You'll see that all of a sudden everything starts, or what apparently looks like it's exploding. Well, I mean, it's not exploding. Let's get real. If someone was trading in my explosive mode, they would think that they were doing unbelievably, right? But that, to me, everything started to get more volatile. And I asked people, well, what do you think happened right there? Most people will say something like, I don't know, the market just went really volatile, the VIX went to hell, or whatever. And I said, no, it has absolutely nothing to do with it. In fact, my returns have little correlation to where the market was going or where the VIX was going. I just go bottom left, top right, and basically a straight line through high VIX, low VIX, market going up, market going down. So what did happen right there? Well, this was the point that I decided that I'm going to scale, that I'm going to increase my position size. And so let's say that in the early goings that my position size was 1x. Now I chose a certain position size to affect a certain outcome. And it had to be according to my account size. Now as my account grows, so does the relationship between my account size and my position size. My position size starts getting smaller as a percentage of what my total account is as it's growing. Well, that's what really affects my volatility. It starts getting narrower because I am consistent in my returns and how I'm affecting the trade, but the relative size of my position, my max position size to my account is getting smaller. Therefore, my ups and downs are getting smaller as well because I'm trading consistently. That's what it really means to trade consistently, that you're doing the same thing over and over and over again. Now, I might be getting lots of big wins, small wins, medium wins, and so forth. That's not what's consistent. What's consistent in the long run is that I am getting a plethora of trades that are within the same range. Now, at some point, I have to decide when I'm going to increase my position size, and that was all pre-planned. And in this particular account, I said, look, when I get to $34,000 in this account, I'm going to increase my position size by 50%. So I did. That's exactly what I did. I increased my position size by 50%, and then that increase in the size of my position is what changed the relationship between my position size and my account size. And so now I'm still trading the same way, but now I'm getting bigger wins and bigger losses. And so that's what's causing the up and down and then the drawdown to get a little bit more excited. But you'll notice that over time, as I lean into that new position size and I'm absorbing those higher wins, higher losses, that eventually it's coming down into control and then it's getting small again, because as I grow the account, again, my position size relative to the account is getting smaller. And so then I would just then repeat that later on once I get to another account size and increase it to, say, 2x of my original size, and then 3x, and so on. Now, one thing that you should note is that when I was in that first leg of my trading account, a lot of my members would say, hey, Ernie, your trading is awesome. Why don't you just 10x your position size? I said, well, if I 10x my position size, then the volatility of my returns is going to explode. It's not going to 10x, it's going to 100x, or much bigger than 10x, that's for sure. And now I would be putting myself at risk of busting my account, and that's definitely not what I want to do. I want to keep on maintaining what I'm maintaining. And going to a much larger size, thinking that you're going to YOLO it, is absolutely the wrong thing to do. You have to be completely in tune to the size of your position relative to the size of your account and understanding what kind of drawdown that you can manage. Now, my drawdown is based on a very exacting formula that is all based on probabilities. And I know that if I keep my position size relative to my account a certain size, then I can manage a drawdown within a certain amount very easily, because that's what my strategy affords. Now, what actually happened is, by increasing my position size by 50%, my drawdowns and the volatility of my returns actually increased by 100%. So it's a non-linear result. And that's the effect of adding more position size relative to your account. It is non-linear. As you go bigger position size, it's kind of like when you're drawing down. Yeah, I'm going to go back to the big head here. It's kind of like when you have a drawdown and you go to, say, 10%. That's pretty easy to recover from, because in order to get back from 10% back to where you were, a new high, you have to gain about 11%. But if you go to 20%, in order to get back to where you were, you have to actually gain about 28, close to 30% to get back to your previous high. You get out of 40 or 50%, and you have to double your account to get back to where you were. So this is the same deal, only in the opposite direction. As you increase your position size, it becomes exponentially more difficult to manage your volatility of returns and your drawdown. And so that's what you want to avoid. Too big of a position is going to be the death knell. And now remember, our goal is compounding. And the only way that you can compound is to have consistent gains, and then increase your position size, and then continue that consistent gains, and then increase your position size. Then you go up at a different trajectory, and then increase your position size, etc. But if you increase it too much, the volatility of your returns will start doing this, and you won't be on that path anymore. You'll draw down big time, and that's like going back in time in the pantheon of compounding. That's the death knell to compounding, any kind of drawdown. So that's what we're trying to avoid. And the only way to keep your drawdown small is with super small positions. Now, I know as a retail trader, you guys out there, that is not what you're doing. You are taking huge risks to make small profits. And because of that, you are having a hard time. Sure, you might make all these tiny little consistent wins, and then you have one loss and it wipes them all out. You are never going to compound, and you will never increase your position size, allowing you to scale. It's impossible. And I mean, that is one of the detriments of a high win rate strategy, that you have to take huge risk in order to make small profits. Yeah, sure, you're winning a lot, but one win just wipes it all out, and you start all over again. And and when you want to scale, that means that you have to take even more risk. It doesn't scale. High win rate strategies does not scale. It is, you'll have a negative expectancy. There's a term by Nassim Taleb I want to use, but I'll get to it in a little bit. It also produces a kind of return, a distribution of returns that's called negative expectancy or negative skew. Left-leaning negative skew. You have a lot of small wins and then some huge losses. And it's going on the wrong side of the curve. You want a positive skew or a right-leaning skew where you have small contained losses and then big wins. That can scale. And the reason why that scales is that in order to scale, you only have to crank up your your position size a little bit, and then the size of your wins grows dramatically. Where on the other side, on the high win rate strategy, you have to crank up your risk huge for incremental increases in your wins. I mean, which way do you want to trade? Come on. I mean, this is kind of like a no-brainer. All right. So, all right. I hope that that was impactful to you, because it's super important. Nitany Finn says, position size meaning number of option shares contracts taken. No, it has more to do with your actual size of your position, your monetary size as a percent of your capital, your trading capital. I mean, just because you're taking more contracts, assuming that you're always taking the exact same size contract, if you add more contracts, then that's going to increase your total notional value or total dollar amount that you're taking. That relative to your total account size is what you're trying to control. And you want to have exacting control on it. So when I trade with a much larger account, I'm typically keeping all of my session positions under 0.6% of my total capital. I would never even start a trade unless I'm around 0.2 or sometimes even lower than that, and then add to it only under certain conditions and never exceed that. So I always know, and believe me, that 0.5, 0.2, 0.1 of a position size relative to my account size and the strategy that I am trading gives me a very exacting and clear expectation on what my worst case scenario drawdown is going to be. And I know exactly when I need to back off, take some mitigation strategies or whatever when I start drawing down too much. And for me, drawing down too much is when I start approaching 2% drawdown. Now, I know most of you are thinking, 2%, man, I do 2%, in the morning. For me, it might take me 10, 15 trades of constant losses to get down to 2%, right, or more. So that it's a very rare thing. Now, my absolute maximum drawdown would be 6%, but I'm not trying to get there every day. I want to stay at that 2% level and keep on increasing my capital so that I can justify going to the next level position size. Now, my position size on any one trade is not my actual, I have a maximum position size. It's this big. And I know that during the day, I might have as many as, 3, 4, 5 trades on. So in total, they can't exceed the maximum position size. But when I put on my first one, it's just a part. Then I put on my second one, it's another part, and that takes up what I have left for that day. So that's how you do it. So, as I said, we were starting with the sacred cow in trading, the idea that if you just rack up small wins every day, your account will grow exponentially. In reality, those small wins often hit a ceiling. And, just being consistent might be the worst scaling advice you'll ever get. Consistency is not the key. All right. So I'm going to go over that myth of just being consistent in trading. Now, this advice works only if your average win size is meaningfully larger than your average loss, or if your small wins are part of a system that captures occasional large gains. So, in other words, and that's basically what our 0DTE and our convex trades are, larger further dated out trades. Most of the time, we're going kind of sideways. Hitting small wins, small losses, small wins, small losses, basically keeping ourselves in the game, or just a slightly small drawdown, and then we get these big wins, and then over and then up. And if you were to look at that account, you'll see that that's exactly what was happening there. Let me go back to that so you can see that. So you'll see that it is kind of a stair-step. I go up with some big wins, and then I go sideways. In fact, this sideways move, this very first sideways move here, that trade where I made a new high was at trade number 12. The next new high I made was at trade number 61. That's almost 50 trades where I went sideways. Then I went up, And here, trade number 66, new high, didn't make another new high until 84, almost 18 trades. New high, trade number 89, another new high, not until 121. Now, just think about what that feels like while you're trading, because you know that most of the time you're just grinding away and you're managing your account, you're waiting for those big wins, right? So that's the nature of taking small positions and small losses and then grinding it out and then waiting for that opportunistic trade that's going to be really big. And that really big trade is going to be 400, 800, 2,000% of the risk that you're taking. And those are the things that jump you up. And the rest of the time, you're not drawing down. You're just not drawing down, right? So this account shows exactly that stair-step approach, right? That's what you want. That is the ultimate in trading. That is well, of course, if you could just go straight up, that would be the ultimate. That would be great, but nobody does that. Or very few. I don't know of anybody that does that. I've seen it done in small periods of time, but and I've had that type of experience over, I've had like a 3-month streak or something, but it never lasts. So that's the key, right? So consistency equates with taking frequent small profit targets, sometimes exiting for $20 or $50 gains over and over again. I mean, that's not what you're trying to do. You don't want to get all these tiny little profits all the time and never have the availability of a big profit. I mean, it's okay to have small profits as long as your strategy is designed to help you hang out until the bigger ones come along. Now, for instance, in this past week, I've had a bunch of small wins, small losses, a couple $100 win, a few $100 loss, up and down, up and down. I think as of yesterday, I was up maybe $700 for this week, and today I'm down about $600. So I'm essentially flat for the week. And that's fine. What each one of those trades, though, that I put on had the potential of making $12,000 to $20,000. So that's what I'm waiting for. I'm waiting for that to come in, and it will. Just like you saw here, this account is a much smaller scale of that, but I'm trading with a much larger account right now. All right. So let's go back to that. Let's see if there are any more questions. Hey, look, if you have questions, put them in the comments section, and I will get to them and I'll answer them. Also, if you like this content, give it a thumbs up, please. Thank you very much. So Nidhi says again, so use XSP or something other than SPX to get down to that position size then? Well, I don't know. It depends on your account size. I don't know why you think you have to use. It really depends on your account size. So for instance, if you have, let's say most traders have maybe a $25,000 or a $30,000 account, there's no reason why you can't trade the SPX with that. If you're using convex trades like what I have, or even the 0 DTE strategy, you should be able to take anywhere from $50 to $150 risks, but your maximum profit potential on those trades should be 10 to 50 times that. So when you're taking a $50 risk, you should be able to make $2,000-$3,000. If you're taking a $150 risk, you should be able to make $5,000, $6,000, $7,000. Right? I'm not saying that that's what you're going to make. I'm saying that should be the maximum possible, so that when you do get those big wins, it's going to be somewhere on that spectrum from small to large. And I went through this yesterday. I showed you the percent of time that I make what I call small wins, medium wins, and big wins. And those really big wins only happen a small percentage of the time, maybe 2.5% of the time. 10% of the time I'm making those medium wins. And when I say a medium win, I'm saying that I'm still making 1,000, 2,000%. In fact, I talked about a medium win on my YouTube channel right at the very front page. I talk about this 950% win that I made, right? And that's great, I made about $1,400 on a $100 bet or something like that. And I think it was $140. They made $1,300 or something like that. It was 950%, whatever it was. And when you hear that someone made 950%, you're thinking, oh my God, that is unreal. But see, for us, that is like a regular occurrence. It's when we start making the 2,000, 4,000, 5,000% winners. Those are the ones that we're after. I don't get me wrong. The 900, 1,200% wins, they elevate the account as well. But the thing is, those really small losses, they do nothing. They just keep us maybe a slow bleed or just go sideways. Now, I don't know how many times I have to say that over and over again. I guess I'm just trying to drive the point home. So the problem with these really high win rate strategies and small, tight wins is that in a high volatility environment, small targets don't cover the inevitable larger losses, commissions, and slippage over time, right? However, in our strategy actually gets stronger in high volatility environments. So we actually can turn it up and increase our position sizes and our overall profit potential. And in the low volatility environments, we just sort of scale down and we just take it easy and we cruise. And we're still putting things out. We're still getting a similar expectancy, but we're just scaled down. So consistency is a good thing. But if it's built on small wins that can't outpace your risk, it's a slow bleed in disguise. All right. Boy, I spent a lot of time on that, almost half the show. So let's talk about how small wins cap growth potential. When you lock yourself into taking only small wins, you're effectively capping your upside while leaving your downside relatively open. That's what I was talking about in terms of the distribution of returns. It's a negative skewed distribution. This creates what Nassim Taleb would call negative asymmetry or negative skew, the exact opposite of what we want. A trader who takes $50 profits but risks $200 per trade needs near perfect win rate just to break even. Okay, this is a big point. Small fixed wins force you to keep betting just to maintain your equity curve, making growth nearly impossible without taking on excessive risk. That's absolutely key. You can't scale with high win rate. You just can't. But with low win rate, asymmetric trades, you can scale easily. And you're exhibiting an anti-fragile, which means that you get stronger in stress, stronger as volatility grows. Your strategy literally gets stronger as volatility goes up. I mean, I can't imagine, most people can't even imagine that. All right, so now let's talk about the compounding advantage of asymmetric setups. An asymmetric setup allows for risking $1 to make $3, $5, or even $10, sometimes as much as $50 in certain 0DTE structures, like well-placed butterflies. This means you can have a lower win rate but still compound over time because your winners more than pay for your losers. Compounding in trading doesn't come from frequency alone, it comes from magnitude. Right? So shift from chasing frequent wins to structuring your trades so that the occasional big winner drives exponential growth. And that's exactly what will drive the growth. You'll make those big wins and then you maintain. Then you make another big win and you maintain. Okay. So I got an itchy nose. I remember when I was a kid, I was told if I have an itchy nose, that means I'm going to get into a fight. So let's define asymmetry in 0DTE before we talk about scaling. We have to get clear on the foundation, asymmetry. So in 0DTE, especially with the butterfly structure, the whole game, everything that we do. Well, let me see. Maybe I can go into a. Let's see what's going on here. All right, I'll go into this strategy that I'm monitoring. Not that. We want to go to Thinkorswim. Okay, so here's a position. It has $738 of risk, but it has somewhere around $14,000, a little over $14,000 of potential profit. Actually about 14,200 and something. And that's what I'm talking about, asymmetry. That's the type of structure that I would like to put on. And you only get that with butterflies. Sure, you can get it with certain types of spreads, but then you're losing out on the optionality aspect of those spreads. So with a butterfly structure, the whole game changes when your risk to reward ratio tilts heavily in your favor. So let's unpack what asymmetric really means and why a skewed payoff can change everything. So when I'm putting on a trade, I am trying to get that kind of asymmetry. Now, I'm not a winner on this trade today, but risking $737 is a fraction of a percent of my account. So I can do this over and over and over again. I've been doing it all week, and I've haven't hit the big win because we're in this really low volatility environment, so they come a little slower. So most of the time I'm managing small wins, small losses, small wins, small losses. But when we get one of those larger moves, overnight moves or whatever, and I'm trading maybe 1 or 2 days out, and I get into one of these profit tents, then one of these trades where I'm betting $700 can return $14,000, $15,000. So now, even if you got an asymmetric setup, scaling isn't as simple as do more of what works. So pressing every trade is a fast track to fragility. So that's an important point. If you think that every trade that you need to be a winner and you need to get the maximum win, then that's gonna screw you. So let's look at how volatility, strike placement, and we'll look at that in some detail, but I want to make that point that in this type of trading, we're opportunistic, and we don't know what's going to happen in the market. We might get a big move that day and then never get inside the profit tent, but we could take that trade off with maybe a 300-400% win. We're going to do it. We have to assess the risk of staying in the trade. We've got some sort of unrealized gain. We want to make sure that we keep it. If on the next day it moves and gets inside of our butterfly, now we have a little bit more time on our hands, and we have lower gamma. We can hang out there and see whether or not optionality is going to, and theta decay is going to work in our favor. And until it doesn't, or until the gamma gets too high, we stay with the trade. So again, it's not like you have to press every trade. Some trades, you get in, you get out. Or if it goes against you, there's not much you can do. All right, so let's take a look at this here. So we're going to talk about why pressing every trade increases fragility. And what I mean by pressing is, trying to squeeze blood out of a stone. Thinking that you have to get inside the profit tent, thinking that every trade has to be a winner. I mean, that's wrong think. It's really bad think. Many traders misunderstand scaling as simply adding size to everything that's working. In reality, if you scale indiscriminately, you magnify not only your winners, but also your variance and your mistakes. Fragility here means your account becomes more sensitive to bad outcomes. A few losing trades can do disproportionate damage. For example, if your average risk per trade is 1% and you suddenly scale to 3% or 4% on a suboptimal setup, you've introduced a structural weakness in your equity curve. And so, for instance, going back to my account over here, If I instead only went up 50% and maybe doubled or tripled or 3x'd it, let's do the figuring on what would have happened. You can see here, I only went up 50% and my volatility increased by 100%. If I increased it by 100%, then my volatility would have increased by 200. If it went to 3% or 3 times, it would have been to 300%. In other words, my drawdowns now would start approaching 25, 30%. You know, I don't need too many bad trades in that kind of structure to risk ruining my account. All I need is just a bad streak, and you can have a bad streak. I mean, if you look at this account, you think, he's winning all the time. But I want to show you something in this log. You can see very clearly that I did not win all the time. Look at this, right? I mean, that's a long losing streak, but they're all small losses. Then occasionally you get big losing streaks like this. That happens. Again, all small losses and big wins. Right? Now, as I scaled up, my small losses are getting a little bit bigger, but so are my wins. So scaling only works when applied selectively to high probability, high payoff situations. Pressing every trade erodes the structural stability of your account. So only press or scale or add to a trade if you think that there's some high probability that you're going to have a good outcome. Otherwise, stay small. Stay small. That's why we're trading small, because if it all does turn around, even if we're small and we're wrong, thinking that, okay, it's not going to turn into anything, then it does, you still make a big return. But if you're consistently trying to press your trades and then push in all the chips, then the volatility of your returns are going to start increasing dramatically, and then you're going to start drawing down even faster. That's where consistency of mindset comes in. So let's talk about how volatility, strike placement, and time decay change risk profile. All right, your risk profile of volatility. Higher implied volatility can make scaling dangerous because options are more expensive and premium decay is less predictable. Well, I mean, the decay will slow down and it will inflate options, and it will give you, well, that's if you're not in the trade. It seems like a gift. However, in low volatility conditions, that can make certain scales less worthwhile. In low volatility, your premium decays much more quickly, so that when you get to a trade, you'll find there's just not as much meat on the bone. And where the day before you might have had high volatility and you thought you were, master of the universe, you get into it the next day because we had a big run up the previous day, and then all of a sudden none of those trades work anymore. And that's why, again, by staying small, it's not going to hurt you. So what about strike placement? Scaling into a position changes your exposure profile. In butterflies, for example, adding contracts further out at different strikes alters the payoff curve, and you can move your break-evens, right? And that's one of the keys to trading butterflies as opposed to spreads. The break-evens are much wider. And also the way the profit curve grows in the course of a day, or as it's going through the aging of that strategy, is also more advantageous to those positions that are outside of the profit tent, which is most of the time. So that's an important thing. That's one of the reasons why we trade butterflies, because they give us a much broader range of profitability and give us more opportunity early on or outside of our trade. We know that we're not going to be getting inside the profit tent very often. Just like in a spread, if you have an out of the money spread, there's very little chance you're going to get in there, but you don't want the premium running away from you like it does in a spread, where in a butterfly, it still runs away from you, but not as fast, and it's kind of growing in your case. So it gives you more opportunity. So let's talk about time decay, and I covered this yesterday. Zero DTE trades are extremely sensitive to time, and they get more sensitive as the day wears on. Scaling later in the day can expose you to accelerated theta decay without enough time for your trade to work. So scaling later in the day it's unnecessary risk, right? Why throw money away? So before scaling, you need to recheck the current market conditions, not just your original setup, because the risk to reward might have shifted. The other thing is, as you go later into the day, particularly between noon and 2:30, volatility is still an impactful thing out there, and it can affect the price of your options by either expanding or contracting the premium available. But once you get to about 2:30, that's when volatility no longer has any real control over your extrinsic value, your premium. Time becomes the final arbiter. So, as I said, let's see, where are we in terms of time here? We are at 3:41. Now, that was a lot of information, and hopefully that made some impact for you. We have a question from Randy. Hey, Ernie, when it comes to applying the volume profile, are you taking the trade when price breakouts or breakdowns from a high volume node, or looking for the rotation back to value? Thanks in advance. Well, so what you're asking is whether or not we're playing the volume profile as our target or not, or are we looking for particular types of patterns where we have breakouts or breakdowns on structural edges of the nodes? And the answer is yes. That's exactly what we're doing in some cases, but we're not. It depends on whether or not we're on zero DTE trades, or if we're a little further dated out. On zero DTE trades, for sure, we're a lot more cognizant about how price is moving across a profile with relation to our butterflies. In most cases, in the morning, you're trying to place those flies according to your risk to reward stack and what kind of ratio you want between risk and reward. And some of it might be influenced by whether or not there are close by volume nodes that make sense that, hey, look, if it goes across this low volume node where there's low liquidity, and I place that butterfly right on the high volume node above it, it'll act like a magnet as price goes up there. I mean, that's a good thought, and that often works. So we do that sort of thing. Absolutely. And then Randy says, I'm going through your live stream series now. Wealth of information and very impressive strategy. Thank you very much, Randy. Really appreciate it. All right. I have a lot more to go, but there's just so much on scaling that I can bring to this. I think I got the major points across. You want to scale, trade small. If you want to compound, trade small. If you want a positive, long-term positive expectancy in your returns, trade small. Don't just trade small, but make sure that you have an asymmetric trade where you have large potential. That is the key. When you trade a high win rate strategy, you have exactly the opposite. That is an extremely fragile strategy. It does not have long-term positive expectancy. In fact, it has negative expectancy. Another way of saying that is that a high win rate strategy over the long term is a loser's strategy. That's the math. All right, so I don't know why you would trade. Well, I know why, because it seems to make sense. Intuitively, you would think, oh, I win a lot, then I'm going to, make money. But it's not true. And of course, everyone's pushing those out there because it's an easy thing to push. They can sell their courses and their brokerage services and everything else because you're going to get duped into thinking that winning a lot, tiny, tiny little wins, is going to make you wealthy when it doesn't. And if it did, and everybody's following this paradigm, why did 90% of traders lose money? Come on, I mean, it's kind of obvious. And why do most of the pro traders trade asymmetrically? Almost exactly the opposite of a retail trader. All I'm doing is presenting to you the path to what pro traders do. Speaking of the path, maybe we can get a word in from convexity. And convexity is my AI. Hey, Vexy, I'm talking to people here about scaling with these asymmetric strategies, and why scaling really requires that you take small position size and have large potential outcomes in order to scale effectively and have any chance of being able to scale or compound. Can you comment on that, please?
Absolutely. And that's exactly the heart of it. When you're looking to scale with asymmetric strategies, the whole idea is that you're keeping your position size relatively small while setting up the potential for a much larger payoff. That's how you get that convexity or that nonlinear upside. If you try to scale by just making everything bigger without that asymmetric potential, you're really just adding linear risk. So the magic is in combining small controlled risk with the chance for a disproportionately large reward. And that's what really allows you to scale effectively over time.
Thank you, Vexy. Can you tell people exactly what you are and who created you and where they can get access to you?
Of course. So I'm basically a reflection and decision support companion for trading. I was created by Coach Ernie to help traders like you find those small asymmetric edges and build an anti-fragile approach. If you're interested in working with me, you can definitely find me through the Fat Tail community and the Final Hour show, and I'm here to help you take your trading to the next level.
Thanks, Vexy.
You're so welcome. Anytime. If you need any more insights or help prepping for the show, just let me know. I'm always here to lend a hand.
Yeah. So anyways, Vexy is a decision support system that I created, built on top of any LLM. It is actually like an operating system on top of the LLM. It knows all about convex trading. It knows how to teach you or be a coach and a mentor to you in a professional environment. So if you're interested in that, you can get access to Vexy by joining Fat Tail. Go to the link down below. It's a school community, and you'll have access to all of our strategies, our campaigns, our process, our methodology, and routines, and you'll learn how to become a professional asymmetric trader. Cool. That's about it for me. I want to thank everybody for joining me here today. And now I have to figure out what's the right button to push. So we'll see you tomorrow. I have a lot of great other topics in store. Oh, wait a minute. We have a couple more questions. I do not want to skip the questions. AAB says Vexy is so convincing. Cool. Yes, we love Vexy. Super smart and really the most sophisticated decision support system that is human focused anywhere. And I can say that with conviction. All right. Thank you all very much. Coach Ernie is out.